This is a short but high impact class. All right, this is a piece of the puzzle of commercial credit training. The core of this class is financial accounting. In order to be great at finance, you have to be great at financial accounting. To be good at finance, you got to be good at financial accounting. There's really no getting around that, right? When you're really good at financial accounting, you can see things that others can't see. I joke around sometimes. It's almost like X-ray vision, right? Like people are looking at the same financials, but the ones with the financial accounting understanding can see things that others can't see. All right. And how great is that in finance? You know, if you ever been in a situation where you're looking at financials and people are picking up on things that you're not able to see and wondering why, financial accounting is the core base. It's like a language, a financial language that we have to know in order to be good at finance. Again, there's really no getting around that. So you're able to see things that others can't see, right? The understanding of financial accounting really unlocks the understanding of finance. And the bottom line is that it comes down to the difference between saying yes to a deal that we should say no to, or no to a deal that we should say yes to. Many times it comes down to that because we're looking at things through the wrong lens without that proper understanding of financial accounting. Let's talk about GAAP versus IRS versus bank lens before we get into the deferred revenue and versus AR, because this is really important. GAAP is generally accepted accounting principles, how the accountants set up the financial statements, balance sheet, income statement, cash flow statement. We take those financial statements and we convert them the way the bank looks at it through spreading. We spread it through a different lens, not taking away information off the financials, not adding to it on the financials, on the spreads, but we make adjustments to what the accounts do. All right. So we're converting GAAP to the bank lens through spreading. The IRS tax returns, we convert these IRS tax returns, which are a little clunky, right? I teach this in credit training, how to navigate tax returns, but we convert that to GAAP and then spread those through the bank's lens. All right. So we take those IRS tax returns and we spread those in a way that is more GAAP, like balance sheet, income statement, cash flow. We spread those in a way that how the bank looks at it. We got to convert those tax returns really to GAAP and then make those adjustments. And when we've done it for years, it's just natural, but we got to have that understanding of knowing that these GAAP and IRS tax returns, we got to convert those to the way the bank looks at it. I'll give you a few examples. Purchase price versus net fixed assets. All right. So if purchase price, let me clean this up here. If purchase price is what and a company pays for a piece of equipment, maybe it's $1 million piece of equipment, right? And this is a heavily depreciated asset. Maybe it's $800,000, sorry for my handwriting, $800,000 of accumulated depreciation. That would leave $200,000 of net fixed assets because it's purchase price that goes on the balance sheet for the asset. But this is heavily depreciated. We can see depreciation here. It's almost fully depreciated, but maybe the equipment is in great condition and we get an appraisal. We have to have a third party. We get an appraisal and the appraisal comes in at $700,000. The off-balance sheet equity is $500,000. We're not seeing that on the balance sheet, but we understand financial accounting. There's the purchase price, there's the net fixed assets, which drives down the number of the purchase price. It's lowering it, but the value of the asset, we just got it appraised and it was $700,000. Leverage, real simple leverage, back to the envelope. The difference between the $200,000 and the $700,000 appraisal would add $500,000 of off-balance sheet equity. We could do an as-is leverage and then adjust that for the off-balance sheet equity that we got using the appraisal, and that would be an adjusted leverage that would increase the denominator, which would lower leverage. All right, so that understanding of how the balance sheet, how GAAP works. It's not value on the balance sheet, it's purchase price. But then there's the accumulated depreciation. How does that work? Net fixed assets, we get the appraisal, there's off balance sheet equity right there. Seeing something that's not on the balance sheet, right, makes a difference between maybe some company that has high leverage and we didn't see that the assets were heavily depreciated, but they're in great condition. There may be some off balance sheet equity. It's the difference between saying no to a deal when maybe we should be saying yes to a deal. All right. Or being concerned about something that we really shouldn't be as concerned about. Right. Another one is subordinated debt. Subordinated debt is debt. It's debt that would be have to be repaid, and it's a liability. So we'd have sub debt here. It's a liability. Say it's 500,000. Liabilities over equity is leverage, real basic leverage. We'll see the full leverage. We would take the liability out of that 500,000 out of the liabilities and put it in equity because it is like equity. It's quasi equity. Sorry, if anyone just signed on, if you could just hit mute, that'd be great. It's like equity. I'm sorry, I'm gonna have to mute some people here. Hang on. It's like equity, all right? It's not equity, but because it's behind the bank looks at it as if it's equity, all right? Because it's not going to get paid back unless the bank allows it to get paid back, nor should it, because if they took out 500,000 of cash to pay this sub debt back, that would really drain liquidity and it would increase leverage, all right? So again, we're looking at something that how does the bank look at the financial statements? Current ratio is another one. The only things that should be in the numerator in the current ratio is cash equivalents, marketable securities, accounts, trade AR, and inventory. But GAAP is allowed to have prepaids in current assets, but we spread that as a long-term asset. So if we're just saying current assets over current liabilities, that's not how we should be looking at it. So that would overinflate liquidity. We should be taking out anything other than cash equivalents, marketable securities, trade AR, and inventory. We should be taking it out and spreading it as long-term. So that's making those adjustments. And those are just 3 examples of how we should be looking at, through the bank's lens, looking at financial statements. So that leads into what we're talking about today with deferred revenue and accounts receivable, of seeing things that others can't see. This deferred revenue is very much a C&I type account on the balance sheet. This is not commercial real estate investment. This is something you're going to see on an operating company set of financial statements. So we're looking at C&I companies. And I'm not going to get into this whole page here, but it's really important to understand what is the difference between C&I lending and commercial real estate investment. And here's some detail on that. All right, a few terms and accounting principles that are core to this class. This is a very financial accounting based class, as you can already start to see. Accrual based accounting versus cash based accounting. We need to understand what that is. More companies use accrual-based accounting, but we have to understand what is cash-based accounting to really make sense of what is accrual-based accounting. That comparison really gives context to truly what is accrual-based accounting. Accrual-based accounting is accounting for revenues and expenses when those transactions occur. All right, as opposed to cash-based accounting is accounting for the revenues and expenses only when cash is received as revenue or paid as expenses. All right. So with accrual-based accounting, that's how we have AR and accounts payable. So if we see AR and accounts AP, we already know it's accrual-based accounting, because a company buys inventory, they sell it, it accounts for in cost of goods sold, but the sale is in revenues. They don't get paid yet. It's on terms, becomes AR. AR is received, becomes cash. They pay back the line of credit that they used to borrow. That's the conversion of assets that they used to borrow to buy the inventory. But when that that revenue, they make the sale, but they didn't receive the cash, that has to be accounted for on the balance sheet as an asset. So that's accounts receivable because they sold the product, they haven't received the funds yet, now it's an asset. All right. So when you see AR, AP, and other accruals on the balance sheet, you know it's accrual-based accounting. So very important to understand that. So let's start to get into AR versus deferred revenue. Another way to say is deferred income. There's other terms. As you finish this class, you'll very much more likely be able to pick up on the different terms that they use for deferred revenue. It'll make more sense when you see it. But of course, if you are not sure of it, of what is this deferred revenue or not, because they called it something different, we should always ask, right? Always ask the accountant, what is this account on in the liability? So why is deferred revenue a liability, right? Has the word revenue in it, so it feels like it should be on the income statement. Why is it a liability? Because it's money that was received for a product or a service before the product was sold or the service was performed. All right. So my company is a perfect example. Credit Training Incorporated has a class. I have a credit training class coming up May 14th. I get paid before the course starts. So I received this cash, but I haven't performed or sold anything yet, right? So the timing is very important. We're going to take a look at that. But because I received the money before, I am liable for the service, right? I am liable to perform. If I do not perform, then I need to give the money back, right? So that's why it's a liability, because I'm liable for that service. That's why it's in the liability section. If I receive $10 for a class, my cash goes up $10, that liability, deferred revenue or deferred income, goes up $10, the balance sheet balances. Is it a real liability? This is a neat concept. Is it a real liability? For example, bank debt, that's a real liability. That has to get paid back, right? This deferred revenue does not have to get paid back. And it's interesting because it's in the liability section, but it does not have to get paid back unless the service is not performed. All right. So in my case, if I didn't perform the service and I got paid up front, then I have to give the money back. Right. So it's not a liability in the sense that they borrowed money and they need to pay it back. It's a liability. It's a different kind of liability. It's a good liability. Very few, if any, but this is a good liability for a company. But this is part of understanding the core operation of a company, right? Is how does this company perform? What does it do? And when you understand the company along with the industry information and you understand credit and financial accounting, then the story makes sense. All right. So the transaction itself for deferred revenue, we have an asset, cash increases, right? I'll bring it over here. I'll clean up my screen a little bit. Cash is going to increase and deferred revenue is going to increase. So in that, if I get $1,000 for a service I haven't performed, deferred revenue down here is going to be $1,000, the balance sheet balances. All right. I got my money up front, but I'm liable for the service. But the balance sheet balances, it makes sense. Key to the deferred revenue is the timing. Timing is really important in understanding this. In red in the middle here, the red is right here. That's the kind of like the horizon. Anything that happened before, if, for example, I received the money before I performed the service, that's deferred revenue. That's why it's a liability, because I'm liable to perform the service. So if I receive the funds before performing the service, it's deferred revenue, it's a liability. If I receive the funds after the service, so I perform the service and then I invoice, now that's an accounts receivable, and that money now is that's an asset. Say it's $1,000, that's $1,000 on my AR aging. That's an asset because I performed the service and there's a company that owes me $1,000. Okay, so it's recorded as an asset. So the timing of it is the key to understanding it. Let's talk about how it impacts leverage. and what leverage is. All right. Leverage, I ask my credit training students this, when we start talking about leverage and we really dig into it, what is leverage? And usually the best I get, well, it's taking liabilities and comparing it to equity. And it's more like I do it because I'm told to do it. We need to look at leverage, but we really need to know what is leverage. And leverage is the long-term viability of a company. How likely are we to how likely is the company, sorry, to survive in the long term viability of the company. If a company has low leverage, say over here, it's 1.3, 1.3 to 1, it's in the sound range. If a company has 4.5 leverage, that's in the high leverage. Which one is more likely to make it in the long term? The one that has sound leverage. So it's not an absolute, but it's more likely. Now, we always got to compare it to the industry average. Vertical IQ has the best industry information in the industry. We need to compare to what the financial benchmarks of are the industry in the industry. But if we don't know what that is, this is the framework that I use. But we would go and look, and if this industry is a high capital intensive company or industry that needs a lot of heavy machinery, they're going to borrow more. It's probably going to have higher leverage on average. We need to compare that to the industry. Maybe the average is 5. So anything above 5, then I would say it starts to get to be high leverage rather than 4. But when I don't know the industry, I use these these benchmarks right here. But we can see higher leverage, it's less likely to make it in the long term than the one that has sound leverage. So what is leverage? The long-term viability of a company. How likely is it to survive in the long term? That's very important. All right, to just understand why are we looking at leverage? We don't just look at it because we're told to look at it. All right, so let's look at the ratio. And there's some things in here I'm not going to get into, but this is the full ratio of leverage. Liabilities minus subordinated debt minus deferred revenue here. Minus deferred revenue. So we're really taking liabilities in this case minus deferred revenue, and we're subtracting it out because it's a good liability to have. It's not like that it needs to get paid back unless the service is not performed. And we'll get to a question that we need to ask companies and really dig into that for the quality of the accounts receivables. Then it would be over equity minus intangibles plus subdebt minus affiliated AR. But keep in mind that this ratio right here it's still conservative. It's if someone didn't really know about deferred revenue and we're subtracting a liability out of the leverage, out of the liability section, say we're not going to include it. Someone might say, we're just taking liabilities and not including it in our leverage covenant. We shouldn't do that. But this is a good liability. And I would say it's still, even that ratio is conservative. Why? Because that liability should have a high probability of converting to revenues. And what happens with revenues? A chunk of it is going to convert to profits. Okay, you got to pay taxes. Maybe there's some expense related to that revenue. You're going to pay taxes on it. So a chunk of it should roll to profits. So long as they retain those profits, that will roll to retained earnings. Retained earnings is equity. If equity increases, so here, if equity increases, leverage decreases. So that's not even including that because there's a few more moving parts. It's a little more of an estimate, and I think it's conservative to just subtract it out of the numerator. So is high leverage due to deferred revenue a bad thing? So before we subtract out the deferred revenue, say, Credit Training Incorporated has leverage of 62 to 1. That is astronomical leverage, right? But if most of it is due to deferred revenue, and without that, then leverage is 2.4 to 1. Hey, this is a good company. We got to understand what deferred revenue is. So for my company, the higher the leverage with the deferred revenue, the better. All right. That's understanding the company. All right, deferred. Let's talk about the timeline of this. Deferred revenue, that's a liability. We've covered that. It's a liability on the balance sheet. It rolls to revenues on the income statement. Once it's performed, once the service is performed, then a chunk of it becomes profit. right? Rolls to the bottom line. They got to pay taxes on it. There may be some expenses related to that revenue. Then, so long as they retain that and don't distribute it out, or all of it, then that will roll to retained earnings, which is equity on the balance sheet. And if equity increases, then the adjusted leverage will decrease. All right. So we would do an as is leverage, and then we would do an adjusted leverage. Here's a accounting of it on the balance sheet and income statement. We see here in this transaction, we see that cash, they received cash of 300,000 for some service that's going to be performed in the future, and deferred revenue increases. Now, I would bring it to long term, then I don't have to worry about it in liquidity. We'll look at that next. I would move it to long term, even though in my class it's 3 months. So in the short term, it's gonna convert to revenues, but just so I don't have to look at it and adjust for it in the liquidity. Although if you do have it in liquidity and you keep it there, then you would just have to subtract it in that ratio. We'll see that next. So I would move it to long-term liability, and once the service is performed and done, then it becomes revenue, drops to the bottom line, most of it or a chunk of it, so long as it's not distributed out, the profits, that rolls to retained earnings. If retained earnings is equity, equity increases, then leverage is going to decrease. All right. So that's the flow of deferred revenue. So let's talk about liquidity. If we keep it in the current liabilities, what the adjustment is going to look like. But what is liquidity? Here are the benchmarks over here for, without knowing what the industry average is, this is what I kind of gauge using terminology, giving my opinion. Is liquidity strong? Is it sound? I don't just say liquidity is 1.2. I say liquidity is sound at 1.2. We should always give our opinion. But what is liquidity? Liquidity is the short-term viability of the company. How likely is a company to survive in the short term, right? Maybe the long-term viability is great, but short-term they're having liquidity issues, or vice versa, right? So with the balance sheet, the financial condition, that's the balance sheet, we see the long-term and the short-term viability of a company, right? It's great, covers both. All right, we should always be looking at liquidity and leverage when we're looking at a balance sheet. So here's the numerator, right? All the things that I said before: cash, cash equivalents, marketable securities, trade AR, and inventory, over current liabilities minus deferred revenue if it's in the current liabilities. Liquidity is definitely not current assets over current liabilities. The bank doesn't look at things like prepaids as a current asset. So we need to move everything other than what's in this numerator to long-term assets. All right, and then be left with this equation right here. So if deferred revenue is in the current liabilities, then we need to take current liabilities minus that deferred revenue. All right. Otherwise, just move it to long term and you won't have to worry about it with liquidity. All right. So let's talk about some benefits of both. Deferred revenue, we know now, is a liability because the company gets paid up front. But with deferred revenue, you cannot borrow against deferred revenue like we can with AR. Company can borrow money against AR. We'll talk about that in a second. But they don't need to borrow against the deferred revenue because they receive the funds up front. They already have the cash, right? With AR, they don't have the cash. They sold something and they're still waiting for the cash. That's why they need short-term capital, which is the line of credit, to cover them in that short term. But deferred revenue, they already have the cash, so there's no reason for the line of credit to need that line of credit. So the higher, as we said before, the higher the deferred revenue liability, the better. It's a good thing, right? I like it when my deferred revenue is really, really high, that liability. I don't like it if bank debt is really, really high for my company, but deferred revenue, I certainly do. So accounts receivable, they can borrow against the AR. We'd get an AR aging, we would take out ineligibles, apply advance rate, typically it's 80%, and then they could borrow on that because they're still waiting for that cash to come in. So that line of credit covers them in that short term. All right. So now let's talk about what the quality of the deferred revenue. What questions should we ask related to deferred revenue? This is an important question to ask to really get at the quality of that deferred revenue. And the question for that deferred revenue is, what is the history of performing? All right, what's the performance history for um, for this deferred revenue? How likely are they to perform? Because that's going to be how likely is that deferred revenue to convert to revenues. For my company, I went 8 years. I've been teaching for almost 10. I went 8 years without missing a class of teaching and having to cancel a class. Then I had to cancel 2 days in a row because I had COVID. COVID is what broke my record. It wasn't like a Tom Brady touchdown record, but COVID broke that record for me. And I was proud of it. You know, like go 8 years, never missed a class at all. And then that happened. But I did not perform. We just postponed those classes and pushed it out. There was 2 different classes I was teaching. I missed one, so we just pushed it out and kept going. So my performance was 100%. So if I was borrowing from a banker should ask me about my history of performing that service, right? What is my history? Have I ever not performed? Have I ever had to give back the money, right? Because I wasn't able to perform. If it's 100%, then that's high quality. If it's less than that, then that diminishes the quality of that deferred revenue. And then it's not as likely to say, yeah, it's going to convert to revenue. So that's a key question right there that you have to really give it depth and context, pointing to the quality of that deferred revenue. So let's, before we finish, let's go over a few examples so we can visualize it. All right. Let's say, I'm just going to use a simple example to start, $600,000 line of credit. We're going to use 500,000 of deferred revenue. We'll say deferred revenue is 500,000 and equity is 200,000. All right. So leverage right there is high because leverage right here, liabilities over equity, is 1.1 million over 200,000. So that equals 5.5 to 1. So leverage is high. But if we take out that deferred revenue, because there's a high probability it's going to convert to revenues, if we take that out, now leverage drops to sound at 3 to 1. All right. So maybe this is something we were concerned about. Wow, leverage is 5.5. That's high, right? It's getting high. But really, when we adjust for that deferred revenue, now it's sound. That's where I like it. That's right in the wheelhouse of where I like to see leverage. So if I didn't know that, then I'm looking at a company and maybe even citing the fact that this has high leverage when it really doesn't. All right. And that does not include that 500,000, of which a chunk of it is going to drop to the bottom line, and net income is connected to retained earnings. And if 300,000 of that converts to retained earnings, that's going to increase the denominator by $300,000. That's not even including that. That's why just subtracting it from the numerator is a conservative position for the bank. Take a look at another one. Now this is, you can have AR and have deferred revenue. You can have both, but here I'm showing no AR. It's deferred revenue. This is the core operations of the company. They have deferred revenue. Looks like liquidity would be like really like, maybe 0.1, really low. But if we move it to long term, then it gets it out of the liquidity. Out of the current liabilities, and then liquidity is is much better. Then now we're looking at leverage. Leverage is 7.6 as is. It's high. Adjusted leverage without the deferred revenue, taking it out, now we're looking at moderate leverage. Look at the difference in our tone of this company. Instead of saying high leverage, we're using the term moderate leverage. Much different tone. I like it, right? I like a company that has moderate leverage. Not even including my estimate of what would roll to equity. If I did, then we're even looking at closer to 2.4 and looking at sound leverage at 2.4. But there's a big difference between this and this right here. This can be the difference between being concerned where we don't need to be, or saying no to a deal when we should say yes, right? So you can see the impact that it has. Now we set covenants, right? We set our covenants. I would set it on the moderate leverage, right? Not this leverage where we're including the deferred revenue. All right. So really important to kind of see that tangible, like what is the impact that this can have? Here's another example where we're looking at as is, it's high leverage, right? Adjusting for the deferred revenue, it's sound. Big difference here. I like this company. It sounds leverage. I would not say it's high. I would say leverage is as is with the deferred revenue is 4.9. However, adjusting out the deferred revenue is 2.7. And that doesn't even include the amount that would roll to equity once it converts to revenue, then profits, then retained earnings, which increases equity. All right. So in summary, the key takeaways, this is for C&I type financials. You can't borrow against the deferred revenue like you can AR, but you don't really need to because the company is receiving, not you, but the company is receiving the funds up front. So they have their capital up front. Deferred revenue, it's recorded as cash when it's received before the product is sold or the service is performed. So the timing is really important, understanding the timing of this when the service is performed. It's not an obligation that has to be paid back like other liabilities like bank debt, right? Accounts payable. Those are real liabilities, right? This one is a good liability. The more, the better. It's a rare good liability. The higher the number, the better. The key, the most important thing is to confirm the quality of that deferred revenue. How likely is the company to perform the service or sell the product? That depends. Good gauge into what is going to happen in the future is to look at what has happened in the past and talk about their history. How have they performed in the past?